Yeah, I mean, they got to a position where it was clearly embarrassing, wasn't it? Every time we get any sort of number to do with a read on prices, whether it's an official CPI, PPI number, whether it's a business survey, whether it's people going on Twitter to moan about what they're having to pay at the shops or the gas station, it's clearly got ahead of them, got away from them, and they've been forced to address it. But of course, the joke is that they're still putting in, what is it? I don't know what they'll end up with, 120, 130 billion in extra stimulus before they stop. And even the stop was quite conditional, if you listen to Jay Powell last night. So it's hardly slamming on the brakes. It's maybe coming off the gas pedal a bit, but it's hardly draconian, is it?
No, it's hardly draconian. And Sean, what I love about you is you're a student of many things. So you would have looked at other phases of inflation historically. And I know, of course, these are very different times with various COVID variants continuing to wreak havoc as well. But how far behind the curve is the Federal Reserve, do you fear?
Well, it's an awful long way, isn't it? If you look at, I mean, if you have CPI running at 6% now, there's some hope it will temper slightly if we stick at the current trends, because if you take shorter sets of months, if you do a 6-month annualized, a 3-month annualized, the rates have finally gone a bit lower than the bigger 1-year annualized rates. So there's not quite as much per month coming through in the States as has been. So we could see CPI go back somewhat next year, but I don't think it's going to go back to 2.5% like the Fed's projecting. And even at 2.5%, theoretically, we should have some sort of positive interest rate. There should be 1% or 2% above that for long-term equilibrium. So what are we talking there? We're already talking 4.5%, 5%, 6% would be a norm, historically speaking. And here we are, we're talking about maybe getting up to 1.75% in 2 years' time.
So what are the ramifications from this? I had a great chat with Julian Howard from GAM. He's a great guy, but he said, look, higher rates are not going to be the answer to fighting the problems we have at the moment as well. Does he have a point, or actually are higher rates the answer to fighting a lot of the problems we either have now or we're going to have down the road?
Well, I think that attitude is very much reflected in the way the futures curve has gone. If you strip out the successive forward 1-year slots from the yield curve, they never get above 2%. Now, how far back do we have to go in time until we could never have conceived of being under 2%? So the market's already thinking that the Fed's going to do what it's done before a couple of times. It's going to have a couple of baby step hikes into while the economy's still booming, and the instant anything looks as though it's going wrong, whether it's in the real economy or in asset markets, everyone expects the Feds to reverse course again. So there's effectively no tightening built in if you believe that expectations have something to do with things.